Every day in a corporation happens dozens, if not hundreds, of transactions. So a firm is constantly buying, selling things, buying assets, selling their products, buying the material they will need to produce their products. And there's so many other things. They're paying their employees, they're buying new assets, making investments. In all of those transactions, they go to the financial statements. So it's very important that you understand the four financial statements. So I'm going to talk to you here about the financial statements, okay? So I'm going to start with the balance sheet. So the balance sheet is an accountant's snapshot of the firm's accounting value at a specific point in time. So the balance sheets, if you take a company in a given moment of time and you should take a picture of that company and you want to take a look how well that company is performing or doing, and you want to gather as much information in one piece of document, you get in the balance sheet. So the most important line of the balance sheet is that first line called cash. You want to always take a look at cash. Cash is so important that there is a financial statement called cash flow statement that I'm going to talk to you a little bit, that I believe it's the most important one. So I'm saying this is the most important line in the balance sheet because the number one reasons businesses they fail in the United States is because they don't manage their cash well. All the assets that a firm should have or buy should have the purpose to generate cash flow at some point. And you want to defer that as much as you can, but you need to have your working capital so you stay in business. And sometimes a company with a great equity power might fail through a crisis. Let's say the coronavirus right now hits the country and this company has a really nice balance sheet, but their cash line is very weak. And so they'll go through all kinds of trouble. So you need to manage that first line really, really well. And I'm going to show you an actually balance sheet. But as for now, I wanted to know that the balance sheet is a very comprehensive statement, okay? So let me go ahead and show you here a balance sheet. So you have two lines or two sides, the left side and the right side. As you can see here, the left side is the assets. So what is a company assets? Is everything that the company owes, everything that company has. So all of my investments, everything that I bought is going to be my asset, okay? So normally a corporation to start and to operate, it needs to have its assets so it can generate cash, it can generate income, it can make a profit. Now, how did that corporation bought those assets? You see in the right size of the balance sheet, you have two options. You can buy it with somebody else's money. So that will be your liability. You got to pay this later, or you can buy it with your own money. So it will be your equity right here. So I would say, this is my opinion, that the number two place you want to look in a balance sheet is the equity. Because if you have your assets minus your liabilities equals your equity, and equity is actually what really truly belongs to me. What I own is my ownership, okay? So that's very important that you understand what equity is. So repeating, assets minus liabilities equals equity. So the balance sheet will be always an equation, okay? So you see the equation right here, assets equals liabilities plus your equity. Therefore, equity equals assets minus your liabilities. So just taking a quick look at your balance sheet, then I can understand a little bit more about your cash. So you see here that's in millions. In 2016, this business here, U.S. corporation, had $157 million, and then in 2017 they have $200 million. So I really like that. So that means their cash position is stronger. Okay. Also, you can take a look at their equity. They had 725 million, and now they have 805 million. So the equity is going down. Therefore, you can take a look at their debt here, and it can be just because of a comparison of the equity increase at a faster rate than debt did. So that's a very good thing. And then you can start making all types of analysis here. I'm going to stop for now. We're going to talk more about how you can actually have a critical eye to make analysis of a business. But I'm just telling you right here in the balance sheet, there's a lot of information. You can see here current assets and fixed assets. Current assets is everything that's short term that I can turn quicker into cash. So it has to do with the liquidity. And liquidity is how you, it's the measure of time to turn an asset into cash. Because again, if you go out of business, how fast can I sell my farm or my land or my tractor? It might take a long time, but I can sell some products that are right here much faster. So you have current and you have fixed assets, which is long-term assets. Okay. So that's a look at your balance sheet. Please note that accounting liquidity is exactly what I told you, is how fast can you turn an asset into cash, debt versus equity. Also, I just talked to you how important it is, your equity and your cash. And also very important that you see the value versus cost. Under GAAP, we're going to use the historical costs. And it might be that those costs are out of date. When you actually go to the market, you're going to have different values. So you have to keep that in mind. So let's talk about the second statement. So this second statement, it's not an overall picture of a company in a given time. The income statement will tell you, will show you the performance of a business for a specific period of time. Normally, that's a year or a quarter. I like to look at this monthly as well. Okay, so the income statement will be revenue minus expenses equals income or your bottom line. So let's take a look. You can divide your income in operations income and non-operational income. So this company here had 2 billion in revenue. The cost of goods sold was 1.6 billion. So it comes down here that you have your operating income to be 190 million. So you already can start making some analysis here. 190 million divided by 2 billion, is that ratio okay? And that will be your margin, your operational income margin. You see here that your cost of goods sold, they represent somewhat significant part of your revenue. And that will be the efficiency analysis. We're going to talk a little about this a little bit later, but you can already start looking at those numbers and have a critical eye for those as well. And then you see here, taxes are a big deal. There's a lot of tax management. And you have the, non-operational burden or expenses, right? You might have to pay interest because if you have too much debt. And those are also called financial leverage. Because let's say if your revenue for whatever reason comes down, those type of expenses, those financial expenses, they remain the same. Right now, let's say you own a house and you have to pay your mortgage, but your revenue actually came down because of coronavirus. Well, you still have that interest expense that's not going anywhere. So we take a closer look at financial leverage in this course as well. I'm going to discuss with you actually very soon about it, because it's something that you want to have a close eye to it. Now, I will talk to you about that the income statement, it's a non-cash statement, okay? So it respects the analysis of GAAP, okay? So under GAAP, when an income and an expense are reported in those statements, it's actually when it was earned or incurred, not when cash changed hands. So let's say that you are a business and you're selling computers, okay? And you sold $2 billion in computers. However, you only received 10% of that money today. Well, in your income statement, you still have the $2 billion revenue, but in your cash statement, you only have 10%. And let's say that your customers never paid you. So you might have that big number of $2 billion of revenue, but you actually never see that money come into your hands. So you want to really understand that the income statement is a non-cash statement. It's very, very important, but you have to make sure you take a very, very close look at your cash flow. So finally, I'm going to jump in here for your cash flow, the statement of cash flow. So there are three activities that you're going to measure. Cash flow from operating activities, I call that CFO, cash flow from operating activities. So CFO for operating. And then you have the cash flow from investing activities, and you have the cash flow from financing activities. Okay, so out of your intuition right now, if I ask you which one is the most important one? Okay, so by far, the most important one is your cash flow from your operating activities, because that will measure a manager's ability to generate cash from its operations. So the cash flow would actually report or statement will allow you to have a very close understanding about inflows and outflows of cash. Where is my cash coming from and where is my cash going to? So let's say in your balance sheet, we just learned that for that given business, we increased $50 million from 2016, 2017. So that's amazing. And then you say, yeah, this company's doing great, right? I actually said that. Well, maybe not. Because what about if that $50 million cash surplus came because I sold my stores, that I couldn't keep up with them and I just sold my stores? Well, that cash came in and it's showing in my balance sheet. But that cash is actually not showing that I'm able to generate cash from my operations. That's what I said. Cash flow from operating activities is the most important one. And then you have your cash flow from investing activities. So normally you want to have a very positive CFO. And normally in a growing business, you want to have a negative cash flow from investing activities. Why? Because investing activities has to do when I'm buying assets so I can expand my company. So if I'm producing and selling computers, now I have a new factory. So I actually bought new land. So I put cash out for that purpose. So my cash flow from investing activities is negative for that period, okay? And then you have finally cash flow from financing activities. That can be anything coming from the financial markets. Let's say you're selling, you got money from a loan, or you get money from equity. You also want to take a very close look at that, because you don't want your money to be coming from debt or from a loan or even from an investor, because you want to be able to generate your cash from your operating activities. Okay, and so in the fourth report is the equity report, which will tell you exactly in your balance sheet what's happening to the equity. Is it going up? Is it going down? You do have a fifth statement. That's the notes. That's when the manager actually write notes about those statements. Okay, but this is the main idea for the financial reports. And I just want to make sure you have a really close understanding of the financial statements, Please reread your chapter, work your exercises, and do not hesitate if you have any questions. You can text me, you can email me, or call me at any time. Thank you very much.